So most of the accounting we've learned is really around corporations, right? Because we've learned about stocks and bonds, and those are things corporations can provide. A little bit about sole proprietorships now and then, but we really haven't talked too much about doing accounting for partnerships, and there are some differences. So that's what we're going to focus on in this chapter. Next week is going to be statement of cash flows, and that is, I think, a difficult, if not the most difficult chapter. So that's why I'm going to try to get a head start on that one on Wednesday. So we'll learn about what it means to form a partnership. What are the pros and cons involved with those? You might remember some of that from your intro to business class. The journal entries associated with partnerships, and how to compute each partner's share of the income or loss. So there are a lot of variations on how you could do that. It's fairly simple, but we'll go through that. And what happens if you add a new partner or you have a partner leave? How do you then, what journal entries do you need? What steps do you have to take? Because technically, what happens anytime you have a partner that gets added or that leaves, you dissolve that partnership and you form a new one, or at least a new company. So there is a process you have to go through. And how do you dissolve a partnership? I'll share with you, just as an example, my daughter works for a law firm, and law firms are often set up as partnerships. And in this law firm, there were 3 partners. It's fairly small office. I think they had 2 or 3 other lawyers and then 5 or 10 staff members. And that was the whole operation. And in fact, my daughter's still working there, but she notified us that one of the partners last week is no longer going to be with the company. He's having personal issues, apparently, and the other 2 partners decided they needed to cut him out. And my daughter was pretty sad about this because she really likes that partner. He's been really helpful to her. And to know that just all of a sudden, he's not going to be part of the partnership anymore. And apparently the other 2 partners are also not real happy about it. They really didn't want to have to do this, but they felt that they had to. So what they have to do now is dissolve that partnership. Now the business can keep operating, but it's not going to be that partnership anymore. It'll probably be a new partnership with just 2 partners, unless they decide to add anybody else. So they're going to have to go through some of what we're talking about here today. Okay, so what is a partnership? There have to be at least 2 partners. The partners can be individuals. They could also be companies. You can have a partnership made up of companies as partners. When I worked for AT&T Wireless, I didn't actually work for AT&T Wireless. I worked for a company that was owned by AT&T Wireless and Bell South. They had a partnership. Now they chose to brand my company that I worked for as AT&T Wireless, but it was also owned by another partner. So let's see. Okay, and the partners are co-owners. All right. So this is something all the partners would have to agree to. And not only agree to be part of the partnership, but whatever the terms are, whatever the agreement says, all the partners have to sign that partnership agreement. For example, how much does each partner have to contribute? What functions? Are they going to be involved in managing the partnership, or are they just going to sit back and collect money? That would be a limited partner. How are the profits, losses going to be divided up? Are the partners going to get salaries? Because that is an option as well. So all of that would get identified in the partnership agreement. Is the partnership just for a specific period of time, or is it going to just keep going on? Now, typically, with a corporation, it can just keep going on forever because the stockholders can keep just trading the stock to somebody else, or they pass on stock to somebody else when they die. But with a partnership, it doesn't work that way. A partner cannot say, when I die, I want my spouse to become a partner. You can't do that unless the other partners agree. And they probably don't want to be partners with the spouse, right? So that means that, again, every time somebody leaves or comes into the partnership, you have to reform. But it also means you have to have a plan for what happens in that case. What happens if a partner decides to leave or a new partner is added? How do we handle that? And we'll get into some examples where there's a bonus in some cases that gets paid to the new person or to the old person. There are a lot of different options. So we'll get to that later. Every partner, as it says here, is an agent of the partnership and can make decisions for the partnership. This is assuming that they're active members. If they're just a limited partner where they're just donating money or investing money and then not involved in the management, then they don't get involved, obviously. But if they're a general partner, they are making decisions on a day-to-day basis for the business, and they have a right to as a partner. So that can create some issues. What if you think something should be done one way, and the partner thinks it should be done another way? Right? That can create conflict, and you're kind of stuck because you're in this partnership together, right? The only way to get out of it would be to dissolve it. So the general partners have unlimited liability. You're liable for the debt of your partnership. You're also liable for the actions of the other partners. If one of your partners commits fraud, you could personally be held liable, even if you had nothing, if you had no knowledge of it. There are ways to limit that liability, but in general, that's the way it would work in a general partnership. The taxes do not get paid by the organization. So if you're a partner, whatever share of the profits you get, you have to declare that on your personal income taxes. So the income tax rate you pay as a partner might be higher than a corporation would pay. Because corporations only pay 21% as the top marginal tax rate. Individuals can pay up to 37%. You might have higher taxes as a partner. The assets of the partnership are owned by all the partners. So maybe you bring your fancy computer to work, and this is the computer you're going to use here as part of your job. Well, it's now property of the partnership. Again, partnerships cannot issue stock. They cannot issue bonds. So how can you bring in more money into the company other than through selling your product or service? You could bring in additional partners, or you could borrow money, or each of the partners might have to put more of their own money in. All right, so as you see, there are a lot of downsides to partnerships. They can work really well when you have a group of professionals that need to share an office and share certain resources, like in a law firm. But there can certainly be a lot of issues. So to sum it up, the benefits of a partnership. The partnership does not pay taxes. It's fairly easy to form, although you would want to work with an attorney to set it up. You combine the skills and the financial resources of all the partners. It's flexible in terms of how you manage the business. If you decide to change it from a partnership to a corporation or LLC, it's not that hard to do, so you have that option. And you don't have a board of directors overseeing things, so it's fairly informal. It's the partners that oversee things. What are the downsides? it's difficult to transfer ownership, right? Because you have to dissolve the partnership in order to change who are the partners. There's less regulation than there is over corporations. You might need multiple partners in order to bring in the capital that the company needs or the expertise the company needs. You might be paying taxes at a higher tax rate. The partnership cannot go on forever, because at some point, I mean, unless medical technology makes it so that we can live forever, at some point the partners die, right? And so the partnership would then change as soon as the first partner died or left for whatever reason. Again, as general partners, you have unlimited liability for the debts and the actions of the partnership. What else? There's the high likelihood of disagreements between partners, and it's difficult to raise money, as I already mentioned. Okay, so it could be the right business ownership structure for some companies, but not for most. One thing I cover in the intro to business class, you might remember if you took it with me, is that only about 10%, it was somewhere around 10% of the businesses in the United States are partnerships. So it's a pretty small percentage. Any questions or comments so far? Okay, so again, a general partnership is where all the partners are active in managing the partnership. In my daughter's law firm that she works for, there were 3 partners and they were all active lawyers. You know, they had their own cases that they were dealing with. They all worked together out of the same office. So they were general partners. Each partner is personally liable to the partnership's creditor. So if the partnership borrows money, each of these general partners is on the hook to make sure that money gets repaid individually, personally on the hook. If you have a limited partnership, that means you have at least one general manager who's managing the business and at least one limited partner who's not managing the business and only contributing money. So the limited partners are only liable for their investment in the firm. They do not have to repay creditors if the partnership fails to pay its debts. There's also what's called a limited liability partnership, or LLP. You will often see that after the name of a law firm. They'll often say, Dewey, Cheatham, and Howe, or whatever is the name of the law firm, LLP. So that stands for limited liability partnership. This structure, this type of partnership, gives all partners limited personal liability. That's a smart way to go, so that the partners don't have to feel that their own personal assets are at risk if the partnership cannot pay its debts. So, quick overview of these 3 forms. There are other forms of partnership as well, but these are the most common. General partnership is easy to start, easy to form. In a limited partnership, the limited partners have limited liability. In a limited liability partnership, partners are protected from other partners' malpractice and debts. Okay, questions or comments? All right, so again, a partnership that's changing who the partners are has to be dissolved legally, right? The business can keep operating, but not under that previous partnership. So another reason you might dissolve the partnership is if it completely ran out of money and went bankrupt. Okay. As it says here, a partnership is like a marriage. You're going into this agreement and there might be fights. Unfortunately, there might be times where you don't see eye to eye. And the only way you want to go your separate ways is to dissolve that partnership, like a couple might dissolve a marriage. So before going into a partnership, you'd really want to think carefully. Do I want to be, married legally to this partner? Not married, but tied legally to this partner. Does that person deal with stress well? What skills do they bring? Do they work hard? Do they work well with others? These would be really important things to think about before you sign on the partnership agreement that you're going to work with this other person. I can tell you stories. I'll just tell you one quickly. My mother back in the 1980s, she was a pretty good business person. She wanted to open up a boutique. She was working full time, but she had money saved up. And so she and her best friend decided to open up this boutique in Beverly Hills. We lived in Southern California at the time. And so my mom put in more than $10,000. I don't remember exactly how much it was, somewhere between $10,000 and $30,000, I believe, of her money. Now, her friend didn't really have any money to put in. But what her friend had to do, she had this really difficult task of flying to Italy, picking out the clothing for the boutique. Some people might look at that as a hard job. Other people would be like, I'm on vacation in Italy, picking out clothing, right? So it was my mom's money, and the friend got to have a trip to Italy, right? So they opened up the boutique, and unfortunately, it wasn't really taking off very quickly. They weren't getting enough customers in. And God bless you, within a pretty short period of time, my mom realized that the partner had taken all the clothes. All of this clothing that my mom had paid for, it got brought back from Italy. Her best friend just took it all. And at that point, she was like, well,
That's not a best friend.
not a best friend. I don't have the clothing anymore. I'm just going to let this business fail. I can't pay the rent. And so it was pretty sad for my mother, both financially, but also from an emotional standpoint. She lost her friend and the business. So that's just one example of how partnerships can go south. So I'm sure in retrospect, she would have said, I don't need this partner. Now, my mom, I'm sure, could have taken a week or two and gone to Italy herself and picked out the clothing, and she would have been fine. But anyways, we learn things the hard way sometimes. Okay, questions or comments? Okay, there is such thing as a family partnership that sometimes family members use it to avoid paying some taxes. You could structure, like if the family's buying an apartment building together. Mom and dad want to buy it, but they're going to bring in Uncle Bob and Cousin Sue and their kids. And so they form a family partnership to purchase this building. That way everybody can put in their money and share the proceeds. And there are tax benefits. So you can do that sort of thing. That's the kind of thing. If you've got enough money to make those kind of big investments, then you'd want to work with an attorney, probably a financial advisor, to help you structure that sort of thing and make sure you set it up correctly. So, as I mentioned, there is a partnership agreement that you would work with a lawyer to sign up. And here is what would be included in that partnership agreement. The name of the partnership, where it's located, the purpose, who are the partners, the date that it started, how much money each partner is supposed to contribute, how you're going to split up profits, losses, and then how the partners can take the money out. What is the process? When they want to actually cash out some of their capital, are there certain limits? How do they do that? How much authority does each partner have in terms of making decisions? How are you going to handle changes in the partnership? as far as who the partners are, how you're going to handle a dissolution, and how you will settle disputes. All of that should be well documented. Again, an attorney should do that, right? Because they know what type of language to use, they understand the law. If you try to do that on your own, it might come back later because maybe you didn't word things properly in your partnership agreement. So let's talk now about dividing, or actually the contributions of the partners. As it says here, contributions are recorded at fair value. You know, we've learned a lot about doing things at book value, right? Like if you sell an asset, you have to know the book value. And well, when partners contribute anything to the partnership, it's not based on the book value that they're contributing. It's based on the market value. God bless you.
Thank you.
So we see here, Ciara and Dale have formed a partnership. And Ciara is contributing $8,000 in cash to the partnership. And Dale is contributing equipment with the book value of $5,600, right? So in his accounting records, based on the depreciation he's taken and the original cost, there's a book value of $5,600. And he also have accounts receivable of $2,000 that he's expecting to receive from his customers. And he's contributing those to the partnership. So it's no longer going to be his equipment. It will now be the partnership's equipment. And it's no longer his accounts receivable. It now belongs to the partnership. However, that's book value. If we look here under fair value, his equipment has a market value, what he could sell it for on the marketplace, for $6,400. And the accounts receivable has a market value of $1,600. So that's how you value the contribution. The fair value, which means the market value. So in that case, actually, they both are making an $8,000 contribution. Okay, any questions on that? Here's the journal entry. So the partnership is getting the equipment and the accounts receivable, and they're issuing to Dale capital of $8,000. It's kind of like stock. That's his ownership in the partnership. Okay. So the partnership has issued that capital to Dale. Ciara contributed $8,000, so the partnership got $8,000 in cash, and again, assigned $8,000 in capital to Ciara. Okay, it's a pretty simple journal entry there. Oh, wow, an exercise already. Now we have a similar example with BJ and Paige. This is exercise 1. This one's similar to the last that we just saw, but it's got a twist to it. Let's go ahead and look at exercise number 1. And if you've got the ability, I encourage you to open up your exercise set. And you can use it to write down your answers. So here we have BJ and Paige. They've formed a partnership. Okay. We have to journalize their contributions. As you see here, BJ is contributing $80,000 in cash and equipment that has a market value of $50,000. Paige is also contributing cash and equipment and a building. We happen to have a building that she could give to the partnership. However, she owes $100,000 on that building, and she's signing that loan over to the partnership. Now the partnership is acquiring her debt of $100,000. So we have to think, how do we journalize these two? Okay, so go ahead and fill in the numbers. Again, make sure your debits equal your credits. Any questions? All right, I'm going to give you a couple minutes to work on that. Okay, closing out the books. Do you remember the closing process we learned earlier in the semester? When you get to the end of the year, there was a 4-step closing process. You have to close out your revenue accounts, then you close out your expense accounts, then you close out income summary, and then you close out the dividends. Sound familiar? Okay. So it's similar with partnerships. There are 4 entries to close the books. You close out the revenue accounts, but instead of retained earnings, you would close them out. Okay, so it's income summary first. So that's exactly the same. Income summary was what we used before, right? And you close out the expenses, also the income summary. But then when you get to step 3, here's where instead of retained earnings, the profit would go into the capital accounts of the partners. Or if there was a loss, it would come out of the capital accounts. Okay? So just think of the capital accounts of the partners as the retained earnings. Would there be dividends in a partnership? Dividends are only for corporations, right? So there would be no dividends. So what you do for the 4th step is you would credit each partner's drawing account and debit their capital account. The drawing account is where they're allowed to actually take the money out. So some of the capital that they earn as partners has to stay in the partnership. But some of the capital they earn, they can withdraw. So whatever goes into the drawing account is what they can actually take out. So let's see, this company had net income of $50,000 and there's a 50-50 split between the partners. Meaning what they have agreed is whatever profits we have, we're going to split equally between the 2 of us, 50-50. So when they close out the books, half of that $50,000 profit goes into Dale's capital account. The other half goes into CRS capital account. Okay? Not that hard, right? Now, it's not always 50-50 because there aren't always 2 partners. And even if there are 2 partners, they can arrange any kind of a split that they want. Like it says here, they could agree on a percentage, 80% and 20% as an example. It could be a proportion. You get 7 shares and I get, well, I shouldn't say shares because that sounds like corporation. For every 7 you get, for every $7 you get, I get $3. Okay, it could be that kind of an arrangement. Or it could be a fraction. God bless you. I get a 1/4, you get 3/4. So any of those mathematical approaches is fine. It's whatever the partners agree to as far as how they'll split up the profits, but that's also how they split up the losses. If the partnership loses money, they would follow the same formula. Now there's some different options here. You could base the split on the capital at the beginning of the year, at the end of the year, or an average. Sometimes some of the partners get a salary. We'll talk more about how that works. If you get a salary. Sometimes the income that they get is a proportion of the interest in the capital account. And sometimes it's a combination of the above. A lot of options. It's up to the partners, whatever arrangement they think is fair. Okay. Interestingly, salaries and interest paid to partners are considered expenses of the partnership. They get taken out before you distribute the rest of the proceeds. So it's kind of strange because a partner is not an employee, but they can get a salary. And that salary comes out of the profits of the company, and then whatever's left over gets divided up amongst the partners. We'll see how sometimes it's better as a partner to get a salary instead of a bigger share of the profits. It just depends on the situation. Also, partners are not considered creditors. if a partner wants to put money into the company, they cannot do it as a loan. They would do it by contributing more capital. So here's an example. Here, let's see. There's Dale and Ciara, and they each get a salary. Dale gets $15,000, Ciara gets $10,000. Now, their partnership earned $68,000 in profit. You have to then take out the salaries. So together, that's $25,000 in salaries for Ciara and Dale, which leaves $43,000 remaining out of the profit. You then split that remaining profit according to whatever arrangement they have. In this case, it's a 50-50 split. So you would take that remaining 43,000, divide it in half. Each partner gets half. So when you add their salaries plus their share of the profits, you notice because they have different salaries, they each got different amounts of money, right? Dale had a higher salary, so he ended up getting more money, even though they got the same split of the profits. So you process the salaries first, and then whatever's left over, you divide. Any questions on that? Okay, here's another example. There's a loss. The company lost $32,000, and there are salaries. So again, $25,000 goes to just covering their salaries, plus they lost the $32,000. That means $57,000 of capital has been used up. That gets equally divided. So that means each partner loses $28,500 of capital. But then when you factor in their salaries, you see the net loss, right? Okay, so this takes a little getting used to. We are going to practice this in the exercise set where we're going to have to go through and allocate profits and salaries. All right, in fact, looks like we have one right now. Exercise number 2. And here we have Chase and Chloe. And exercise number 2. By the way, there are only 4 exercises. Like I told you, it's kind of a light chapter. Okay, so exercise number 2, Chase and Chloe. They share profits and losses 70-30. So Chase gets 70%, Chloe gets 30%. Chloe gets a $10,000 salary. Chase does not get a salary. Okay, let's go through A together. And then I'll have you try and do B and C on your own. So let's put in the salaries. Again, Chase does not get one. Chloe gets $10,000. That's a total of $10,000 of salaries, right? And in fact, that's going to be the same in all 3 situations. So let's go ahead and put that under B and C as well. So after you put in the salaries, the next step is your total division of income. In step A, the partnership earned $30,000. So that goes in the bottom right corner. For step B, same thing. That's at $6,000. And in step C, the partnership lost $10,000. Oh, am I recording this? Okay, no, that's okay. I'll stop recording the call. Okay. You start off with the salaries, then you put the total profit or loss in the bottom right corner. The next step is you have to say, okay, if there was $30,000 that was earned and 10,000 went to salaries, that leaves 20,000 remaining. Okay? You take the total division of income minus the total salaries to get the remaining income allocation. So you'll have to do that for B and C. Any questions so far? Then we apply our 70-30 ratio. So we take this $20,000 and Chase is getting 70%. Right, so you can just use a calculator. Say $20,000 times 70%. That's $14,000 for Chase. And Chloe's getting 30%. $20,000 times 30%, $6,000 for Chloe. The next step, you're going to add the columns. The Chase gets a total of 14,000. Chloe, even though she gets a smaller percentage because she has a salary, she gets 16,000 of capital. And then you can double check your answer, because if you add these together, you should get the total, right? 14,000 plus 16,000 equals 30,000. Again, step one, we already did. We put in the salaries. Step two, we already did. Put in the total profit or loss. Now what you have to do is figure out what is the total division of income minus the salaries. That'll be your remaining income allocation. You then apply the 70-30 split, and then you total your columns. Go ahead and do that for B and C. Any questions? Okay. We're already halfway through the chapter, so keep going. We might finish it up today. Okay, yeah, I remember this scenario. So we've got Michael, he owns a salon. He's a sole owner. And he's talking to one of his clients about becoming a partner. So he already has assets worth $500,000 in his salon. I don't know what that is, but maybe it's the building and the equipment. The client, Jesse, would invest $300,000 to make the salon better. Michael would continue working full-time at the salon. Jesse's only going to work there part-time. How should they divide up their profits? What would you recommend? If you were an attorney or an accountant, these guys are coming to you saying, hey, we want to structure some sort of partnership here. We don't know how we should split the profits or the losses. What would you recommend based on the fact that the capital is $500,000 from Michael, $300,000 from Jesse? Michael will work full-time, Jesse will work part-time. What would be fair?
$75-25.
What was that? Huh? 75-25?
Yeah.
Okay, so split. Michael gets 75, Jesse gets 25. Okay. Certainly an option. If they both agree to it, that's all that really matters, right? Any other ideas about how we could structure it? Should there be a salary component?
Hourly wage.
Hourly? Well, that's an interesting point. I think that might get a little too complicated because it varies so much. So I think partners would be more likely to do a salary where they get a set amount per month. I'm not sure. Maybe there are partnerships like that, but I would think they would probably do salary. So if they do a salary, who should get a salary? Both partners or just one? Both? Okay. If they're both going to be working there, it makes sense they would both get a salary. Would that salary be the same for both? No? No, why not?
I think Michael's putting in more effort.
Michael's gonna be full-time, Jesse's only part-time, right? So they might want to set different salaries where Michael gets more and Jesse gets less. You could do a 75-25 split. You could say like a 5-3 split. Could be another way to do it. So there's no right answer. Again, it's whatever the partners feel is fair. All right, so let's say we have a new partner coming in. Sometimes the partner will come in and they'll contribute money or other types of assets. Maybe not always. There might be times where you could become a partner just because they want you to be part of the team. Possible. Or you could be buying out a partner who's leaving. That could be another option. Again, technically, it would be a new partnership, but still, one partner is leaving. You could either pay the partnership, or you could actually pay the partner that's leaving as a way to earn your capital. Okay, so here's one example. In this case, it's a transfer from one partner to the other. So Remy is the new partner, Dale is the old partner. Who was it? Dale and Ciara, right? So maybe Ciara and Dale got into a fight, and Ciara kicked Dale out of the company, and Remy came in to take his place. So in this scenario, the partnership is just moving the capital out of Dale's account into Remy's account. And Remy would pay Dale directly for his portion. What is it, 55,000? So that was the agreed upon amount. Remy gives the 55,000 to Dale and takes over his share. This would be one way to do it. Another way, let's say Remy says, I don't want to deal with Dale. I don't want to talk to him. I don't want to write him a check. I'd rather give my $55,000 directly to the partnership. Partnership would say, okay, give us the cash and we'll give you $55,000 in capital and we'll deal with Dale. We'll get him to buy out his, to pay off his own capital. Or actually, no, they would be paying him off. Anyway. So you could structure it either way. The old investor or the old partner gets paid by the new partner, or the partnership gets paid by the new partner. Either way. Now, sometimes there's a bonus. In this case, it says there's a bonus to the old partner. So it's kind of easier if we just look at the example, I think. So there were two partners initially. Each one had contributed $50,000. See, where does it say that? Doesn't say it. Okay, oh, here it is. Dale and Ciara were the previous partners, or the original partners. Okay, Dale and Ciara had each put in $50,000, so there was a total $100,000 of capital in the building, in the partnership. Then Remy comes in, and they say to Remy, okay, you contribute $65,000. Now remember, Dale and Ciara each put in only $50,000, but Remy's going to put in $65,000. So now the partnership has 165,000 in capital, and they're going to split it 3 ways evenly. That means they each have $55,000 worth of capital. Dale and Ciara only put in 50,000, but now they have 55,000. They got a bonus from the incoming partner. So look at it this way. Again, there was $100,000 of capital originally from the 2 partners that each put in 50,000. Remy came in and contributed 65,000, so total capital of 165,000. Split that 3 ways. Each partner gets $55,000 of capital, which means that $10,000 from Remy's contribution is a bonus to the 2 existing partners. So Dale's partner goes up, Dale's capital goes up by 5,000. Ciara's capital goes up by 5,000. Remy gets $55,000 of capital, even though he paid 65,000. We are going to have an exercise and a problem like this one. So you just need to kind of work through it step by step. Any questions on this example? Okay, sometimes it might be the opposite. Instead of the existing partners getting a bonus from the new partner, sometimes the existing partners might give a bonus to the new partner. So if there's somebody you really want to be a partner, that bonus might be an incentive to get them to come on board. So that's what's happening here. In this case, the 2 original partners had each contributed 55,000. So between them, there was $110,000 of capital. Remy comes in, he only has to pay 40,000. Now there's 150,000 total, right? Divide that 3 ways. That means each partner gets $50,000 of capital. And remember, Remy only put in 40,000 in cash. So he's getting a $10,000 bonus. So now we see he puts in 40,000. Dale's capital goes down by 5,000. Ciara's capital goes down by 5,000. And Remy has 50,000. So he got the bonus. Okay, questions? All right, exercise 3 already. We're going to be done with the exercise set before we even get done with the lecture. This side. Okay, so this is very similar. I'm gonna have you do it on your own, but let's take a look at it together. Tasha and Bill. Somebody was busy coming up with a lot of names in this chapter. Tasha and Bill have a 50-50 split. Currently, they have $45,000 balances each. Ashanti is going to contribute 60,000, and then they're going to have a split, an even 3-way split between them. So you have to figure out what is the beginning capital, right? Then add the amount that came from Ashanti to get the total capital. Then divide that in 3, so you see how much capital each partner has. And then figure out how much of a bonus Tasha and Bill are getting. Here would be the combined bonus, and then here would be the amount each one individually is getting. Any questions? Okay, take a few minutes and figure that out. Okay, so Dale is ready to retire. I didn't like Dale anyways. Okay, So Ciara and Remy agree to pay Dale $30,000 each to close out his partnership account. So why would they be doing this? Well, sometimes the amount that gets paid out to a partner who's leaving might be different than their actual capital. You might be paying them extra for various reasons. So, for example, if you feel that the book value of their capital is really not reflective of what it's worth, because maybe the partnership just got this huge account, it's going to be making all this money, and this partner is leaving right before things really get big. They think, it's not really fair to just pay you what your capital is worth. We think that you deserve more because of how well the company is doing. Why else? Maybe we just really want to get that partner out. Like, okay, if you leave today, we'll give you extra money. How's that? Or maybe to show appreciation. You founded this company, you taught us so much, we want to give you some extra money now that you're leaving. So whatever the reason is, there might be cases where you give a bonus to a departing partner. So that's what we see here, similar to some of the other journal entries we've seen. So Dale had $60,000 of capital. That's getting closed out of his capital account. Ciara is contributing $10,000 out of her capital, and Remy's contributing $10,000 as well. So they're giving a $20,000 bonus to Dale. So he gets not only his $60,000, but $20,000 more. He walks away with $80,000 in cash. Okay. So on the other hand, there might be a case where a partner who's leaving pays a bonus to the remaining partners. And again, it could be for a variety of reasons. Maybe the partnership is not really worth what it looks like on the books. Maybe the partnership's having some issues, or maybe the partner just really wants to get out. Here, I'll give you a bonus, just let me out of this deal. So here's what that might look like. Again, if it's Dale, he's clearing out his $60,000, but actually giving bonuses of $5,000 to the other partners. And he's only walking away with $50,000, even though he had $60,000 in capital. Okay, questions or comments? So why do partnerships dissolve? Well, as it says here, if a general partner does not make good on their deficit capital balance. In other words, you've got a partner that's taken out all of their capital, or if the company had losses and that partner ends up with negative capital, as we've seen sometimes once you pay the salaries and divide up the losses, it can have a negative impact on a partner's capital. And if that puts them below zero, they really have no capital left. They're not willing to put money in. The other partners might say, got to cut you loose. So again, you have to dissolve the partnership. Now the process to do that, legally, you close it out. Say this partnership doesn't exist, and then you could replace it with a new partnership or other form of business. But then financially, you have to do that as well. You have to close out the books. You have to get rid of all the assets, pay off the liabilities, spread out whatever's left over among the remaining partners, and then form the new business. In some cases, you might be able to just transfer some of those assets and liabilities, but you still have to account for them. So this process of closing out the books on a business that's dissolving is liquidation. Like, you ever seen a store that's having a liquidation sale, right? It means they're getting rid of everything. Or we talked about how liquidity ratios are your ability to pay off your short-term debts. So same idea here. We're just getting rid of the debts, liquidating it so that whatever's left over, those assets then get distributed among the partners. So just like we would do at the end of the year, you close out the books, right? We saw that the four-step closing process was pretty similar with a partnership as with a corporation. Close out revenues to income summary, close out expenses to income summary. Then you close out income summary to the capital accounts, and then from the capital accounts to the drawing accounts. Okay. But then you sell off any other assets of the company. Take the gains or the losses from the sale of those assets, divide those among the partners, pay off any debts, and then whatever's left over gets distributed to the partners. So that would be the liquidation process. So here's an example of that. Don't worry, these are just details for this particular company. This is their balance sheet. So we would have to, again, sell off the assets after closing the books. We see that here. This company had 10,000 in accounts receivable, 22,000 in inventory, 30,000 in equipment, and $5,000 in depreciation on the equipment. They sold all of their assets for $60,000, which gave them a $3,000 gain. We've done that before, right? Basically, you add up the debits, we get $65,000, subtract the value of the assets, and what's left over is your gain. Okay, then that $3,000 gain gets split among the partners. In this case, there are 3 partners. Their split is Raven gets $3 for every $2 that Brown gets and every $1 that Eagle gets. So it's 3 to 2 to 1. Or another way to look at it, 3/6 for Raven, 2/6 for Brown, and 1/6 for Eagle. Do you see how that comes out? Raven gets 1,500, Brown 1,000, Eagle 500. That divides up the gains. Then you pay off the debts. Partnership had $30,000 in debts, so they use their cash to pay that off. And there's remaining cash. They had $35,000 remaining. So again, that would be the same split. It's kind of interesting because it doesn't look like the same split, but I remember taking a close look at this one before. Let's see. Yeah, it explains it down here. So Raven had a $15,000 split plus the $1,500 gain. Brown had 10,000 plus a $1,000 gain, and Eagle had 7,000 plus a $500 gain. So that's where these totals come from here. So I don't think we saw where those original splits were. Okay, so we're up to exercise number 4. Any questions? So let me pause again. So in summary, what did we learn in this chapter? All right, we learned about partnerships, obviously. And so let's see, Partnerships do not pay tax. Instead, the partners pay income taxes based on their share of the profits individually. The partnerships have a lot of different variations. In a general partnership, each partner is involved in managing the partnership, but limited partners would only contribute money. They're not involved in managing, so that would be a limited partnership. And then there are ways to limit the liability of the partners as well. A lot of different options. All of it really needs to be specified in the partnership agreement as far as who's responsible for what, how much each partner has to contribute, etc., how you're going to resolve disputes. So when partners contribute assets, they contribute those assets at market value, not book value. Sometimes partners are given ownership based on their expertise or experience. So there might be a partner that doesn't have to pay anything to become a partner, or maybe they even get a bonus to become a partner because of what they can bring to the partnership. How you split up the profits and losses could be a fixed ratio, could be based on the balances of the capital account, or any combination. Whenever you add somebody to the partnership, you dissolve the old partnership and form a new one. Same thing if somebody leaves. When you have a partner coming in and a partner going out, the incoming partner could pay the outgoing partner directly or through the partnership. And let's see, when you dissolve a partnership, you have to close out the books, sell off any assets, pay off any liabilities, and then distribute the remaining cash. So that's basically what we learned today. All in one session. All right, and we finished our exercise set, so let me stop recording here.